Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, the S&P 500 just notched yet another all-time high. Let's start there. What is driving markets higher in the face of all this uncertainty?
The short answer? The data is simply better than expected, and investors are partying while they still can. The U.S. Economic Surprise Index has swung from pessimism to optimism in just a few weeks. In late June, there was real concern that tariffs would choke off growth. But fast forward to mid-July, and every major data point, retail sales, producer prices, import inflation, is beating expectations. Retail sales surged. Import prices softer than feared. Inflation real, but not yet derailing the consumer. And all of that has given markets a reason to keep climbing. It is a front-loaded boom, a kind of buy now before it gets worse dynamic playing out in both boardrooms and living rooms. And while the Fed watches quietly from the sidelines, investors are leaning into equities. It is optimism, but with one eye on the exit.
So this is really a last hurrah before the tariff drag kicks in?
Exactly. What we are seeing is a scramble. Businesses are front-running input costs, locking in orders now before prices rise. Consumers are spending before inflation really bites. It is like the economy is inhaling deeply before the next wave hits. But that is not to say it is all smooth sailing. Bond markets, for example, are far more cautious. The 10-year Treasury yield is hovering near cycle highs. Inflation is here, and even if it is transitory, it is still pressuring the Fed's timeline. And while equities are rallying, it is happening under the surface of rising volatility in yields and FX markets. So yes, growth looks good, but the market knows this is a narrow window. And what comes next? That depends a lot on politics.
Speaking of politics, there was quite a bit of drama this week around Fed Chair Powell. What happened?
Ah yes, the latest chapter in the Trump versus Fed saga. For a moment, markets genuinely feared that President Trump was preparing to sack Powell before his term ends in May 2026. The rumor mill went into overdrive, bond yields spiked, and even the dollar twitched. Eventually, Trump dialed it back, saying it was highly unlikely. But the damage was done. What we learned is this. Trump is thinking about ways to influence monetary policy. And with the 2026 midterms looming, that impulse will only grow stronger. This is not just headline noise. The Fed's independence is being tested in real time, and markets are increasingly having to price in political risk, not just policy risk.
But amidst all that tension, we had some legislative progress in an entirely different asset class, crypto.
Yes, and this one flew a bit under the radar. The U.S. House passed a landmark bill this week, the first real regulatory framework for stablecoins. It is expected to become law later this year, which would mark the first time the U.S. has created a binding legal structure for crypto issuers. It is part of a broader trend. Crypto is becoming institutional. The chaos of the early days is being replaced with real frameworks, real regulation, and, crucially, real capital. By the end of September, we could see the full architecture for crypto regulation in place. Call it the Genius Act, or just long overdue common sense. Either way, it is a step toward legitimacy.
Before we close, a quick pivot to Japan. There is talk of a potential credit downgrade. How serious is this?
It is serious but not immediate. Fitch, S&P, and Moody's all still have Japan rated solidly investment grade, but they are all ringing alarm bells about the same issue: debt. Japan's debt to GDP is an eye-watering 250%, and the pre-election fiscal giveaways are not helping. With elections approaching and opposition parties calling for tax cuts, rating agencies are watching closely. If the government loosens too much without a growth plan, a downgrade is possible. Maybe not this quarter, but certainly in the next 12 to 18 months. And here is the twist. Rising Japanese bond yields are now pulling global yields higher. Japan is no longer a passive player in the global fixed income market.
That's it for this week. Stay tuned for more insights next time.